The dollar has been in full retreat since the Federal Reserve came out with a surprisingly dovish policy statement. So, what does this mean for future rate hikes? And is the US economy now a concern? With me to discuss this is Steven Englander, Head of Global FX Strategy at Citigroup. Steven, how surprised were you by this Fed statement?
Well, I came into this very much on the dovish side, and I was astounded at the take no prisoners dovishness tone.
It was that bad.
And it was interesting because I think part of what got Wall Street upset is that the references to the economy being okay, the inflation picking up, they were dismissed in a very cursory sort of way. And I'd say that half the strategists, economists on Wall Street came from the Fed, and so they would be doing the same kind of analysis that the Fed would be doing.
So is the Fed no longer data dependent? It was fully data dependent all of 2015 and before. So what about now?
Well, I think investors are concluding they're data dependent when the data are coming out on the soft side, but when the data are coming out as per their expectations, or inflation, core inflation, stronger than expected and rising, that they're not so data dependent. The question is, what is driving this distancing?
Yes. Okay. Well, let's look at our first chart. This is euro dollar. There, right at the end, is the impact of the statement. To what extent, Steve? I mean, I refer to it as Draghi's problem that they've got a rising euro. To what extent do you think is the Fed working with other central banks to try and maintain a certain equilibrium across exchange rates?
There was a lot of speculation, even among people who were hawkishness, about what had transpired at G20. Because since then, you've seen China assiduous in stabilizing dollar CNY, dollar CNH. You've seen the ECB not using the most powerful weapon they had to weaken the currency. And Bank of Japan just passed completely. Coming into FOMC, we were discussing what would it mean if the Fed was dovish, but no one expected them to be this dovish.
Yes. Our second chart just goes to show the extent to which the dollar has fallen. This is the 1% club. This is every currency that has moved more than 1% since that, in the 24 hours since the Fed statement. And there you could see that list really does take no prisoners. The euro's in there, the British pound is in there, lots of the dollar blocks in there. It's almost as if the Fed was actually deliberately wanting a weaker dollar.
Well, I think there's a sense, which is probably correct, that a weaker dollar is in the interest of the world. The U.S. certainly loves a weak dollar. It would stabilize EM, get commodity prices up, maybe get oil prices up, so take some of the pressure off banks that we've seen, lower CDS. The question has always been, could you get Europe and Japan to sign on? Because they were the countries where you thought the governments were most committed to currency weakness. And it looks like it was the case that they said, if you guys can follow this policy, get equity prices up, make the rest of asset markets perform better, we'll take the hit and see how it works.
And our third chart is about how the emerging markets currencies have been faring. We saw, Steve, this rally all the year, and then actually at the beginning of this week we saw it come off. To the extent to which the question was the rally over? Hey, it's back up again, as we saw in the previous chart. So to what extent do you feel that investors should now feel a bit more confident about investing in emerging market currencies?
I think it very much depends on your horizon. We saw last year the Fed came up with a similarly ultra-dovish statement in March. Dollar weakened for about 2 months and then began gradually to resume its climb as the U.S. data inexorably were better. I think right now the message that markets are taking is that G20 central banks are committed to reducing risk premia in assets, and you just rank your assets, whether currencies or non-currency assets, from highest risk premium to the lowest, and you buy the ones with the highest risk premium because the central banks are telling you that's what they want to get down.
Steve, just finally, over the next month or 2 months maybe, where do you invest and where do you not invest?
I don't think safe havens are necessarily a good investment. I think that we'll still see the Bank of Japan coming up with a package, probably not focused on currencies, but they have issues with their banks and some of the rest of their financial sector. So I think that they will try and emulate the ECB in what they did. And I think risk will be bid. High beta assets is where you want to be.
Emerging markets looks like the place to be. Steve, thank you very much.
Pleasure.